Welcome back to the Accounting for Financial Modeling, and in this lesson, we'll go over the cash flow statement. Up until now, we've reviewed the income statement, which shows the operating performance of a company and consists of revenue, expenses, and net income. And remember that the income statement is based on accrual accounting principles. We recorded revenue when we sold our products or services, and not when we received cash from the sale of those products or services. And we recorded expenses based on the matching principles. We matched our expenses to revenue, therefore, the net income generated by our operations is based on the accrual accounting. Next, we reviewed the balance sheet, which consists of assets, liabilities, and equity. And the final financial statement, which is important for financial analysis and financial modeling, is the statement of cash flows, or cash flow statement. The cash flow statement reports cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. In fact, if you remember, we've already been introduced to the cash flow statement in homework number 4 when we calculated the cash ending balance in year 2. For example, when we worked on the change in cash in year 2, we calculated cash coming from our operations, and then we calculated cash coming from our investing activities, and finally, we calculated cash coming from our financing activities. And the sum of all these cash flow activities gave us the change in cash in year 2. So we've already been introduced to the cash flow statement, albeit that was an informal introduction. So what is the cash flow statement? The cash flow statement shows a company's cash flow over a particular period. In other words, the cash flow statement reconciles the net income coming from operations to the cash that we receive from our operations, and the cash flow statement produces a change in cash, which allows us to get the cash ending balance. The cash flow statement also shows whether a company is generating cash from its operations and whether that cash is sufficient to cover the cash usage in its investing and financing activities. Therefore, it's important for the purpose of financial modeling and financial analysis to review both the income statement and the cash flow statement. The income statement only gives one side of the company's performance because it's based on accrual accounting. The income statement does not provide us with enough information on whether a company is cash flow positive or negative, which has important implications, for example, for valuation or credit analysis. So the cash flow statement complements the income statement because it shows the movement of cash in a company's operating, investing, and financing activities. A company may be profitable based on the income statement, however, it may be generating negative cash flow in its operations. There are two ways to present the cash flow statement. The first one is an indirect method, and the second one is a direct method. The main difference between these methods is in the presentation of the cash flow from operations. Under the indirect method, we start with net income, and then we add back the non-cash expenses. Remember that in our homework number 4, we added back the depreciation and amortization expenses to the net income to arrive at the cash flow from operations. And we added back depreciation and amortization because those are non-cash expenses. Next, we have to deduct the increase in operating assets. Again, remember that in our homework, we deducted the increase in accounts receivable and inventory from the net income to get to the cash flow. And finally, we have to add back the increase in operating liabilities. Operating liabilities include accounts payable, accrued expenses, and deferred revenue. So we start with the net income, then we add back non-cash expenses, deduct the increase in operating assets, and add the increase in operating liabilities to arrive at the operating cash flow. When it comes to the direct method of cash flow statement presentation, we start with the cash receipts from customers, and then we have to deduct the cash paid to suppliers, vendors, and employees. And in this way, we get to the cash flow from operations. The vast majority of companies report the cash flow statement under the indirect method because it's more simple to prepare compared to the cash flow statement under the direct method. Let's now review the cash flow statement of Walmart. You can see that Walmart's cash flow statement is divided into 3 sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Walmart reports its cash from operating activities using the indirect method, and therefore, the first item that appears in the cash flow from operating activities is net income. Then we've got the adjustments to reconcile the net income to net cash provided by operating activities. And the biggest adjustment is depreciation and amortization expenses, and this is usually true for other companies as well. Depreciation and amortization represent non cash expenses, and these expenses are included in the cost of goods sold and SG&A, and therefore we deduct them from the revenue. So we have to add them back to the net income to arrive at the cash coming from the operating activities. After the depreciation or amortization, we've got the adjustments related to the changes in operating assets and liabilities. Remember that operating assets and liabilities include the accounts receivable, inventory, accounts payable, accrued expenses, and deferred revenue. In the case of Walmart, we can see that we are deducting changes in the accounts receivable and inventory, and then we are adding back changes in accounts payable and accrued liabilities. Next, we've got other non cash expenses that have to be added to the net income. In homework number 4, we had an impairment expense, and we had to add it back to the net income to get to the cash flow. In the case of Walmart, what we've got is net unrealized and realized losses, losses on disposal of business operations, pension contributions, deferred income taxes, and other operating activities. After the cash flow from operating activities, we've got the cash flow from investing activities. And remember in our homework, we included the purchase of ice cream stands, purchase of the warehouse, and purchase of the trademark under the cash flow from investing activities. Similarly, the first item that Walmart reports under the cash flow from investing activities is a payment for property and equipment, which is the acquisition of property and equipment. Acquisition of the property and equipment has a negative sign because we are paying for the property and equipment, and therefore cash is going out. Next, we've got the proceeds from the disposal of the property and equipment and proceeds from the disposal of certain operations. The proceeds from the disposal have a positive sign because we are selling our assets and therefore cash is coming in. Next, we've got the payments for business acquisitions, and the numbers have a negative sign because we are paying to acquire assets and therefore cash is going out of the business. So these are the major items that appear under the cash flow from investing activities, and next we've got the cash flow from financing activities. If you remember, we included debt financing, debt repayment, and equity financing under the cash flow from financing activities in our homework number 4. And in the case of Walmart, the first item that we see is the net change in short-term borrowings, and we see that all of the numbers are negative. And this means that on a net basis, Walmart was repaying short-term borrowings. Then we've got the proceeds from the issuance of long-term debt, and this will always be positive because we are raising financing from the bank, and therefore cash is coming into the company. Next, we've got the repayment of long-term debt with a negative sign because cash is going out of the business. And finally, we've got the items that are related to equity, such as dividends and repurchases of the stock. So this is the cash flow statement of Walmart, and you can see that it is not that different from the cash flow statement that we derived in our homework number 4. Sometimes it may be confusing when we're trying to decide what sign a particular line item in the cash flow statement should have. And what helps in these situations is to view the cash flow statement through the concept of sources and uses of funds. For example, we start with a net income in the cash from operations section, and net income represents the sources of funds, therefore it should have a positive sign. Next, we've got the increase in operating assets, and this increase in assets represents the uses of funds, therefore it has a negative sign. So when our operating assets increase, for example, when there is an increase in inventory, that means that we are using our cash to purchase the additional asset, so there will be a reduction in cash, and therefore an increase in operating assets will have a negative sign. An increase in operating liabilities is the opposite of an increase in operating assets. So an increase in operating liabilities represents sources of funds, therefore it should have a positive sign. Next, we've got the cash from investing activities, which really represents changes in the long-term assets. The first item is capital expenditure or increase in long-term assets. And an increase in assets means we are using our funds, therefore it should have a negative sign. Asset sale or business sale is a decrease in long-term assets, therefore it represents the sources of funds. When we sell all our assets, cash is coming in, so it's a source of cash and it has to have a positive sign. After the cash from investing activities, we've got the cash from financing activities. The issuance of debt represents a source of funds because it's an increase in financial liabilities. We are issuing debt, cash is coming into the business, and our financial liability is increasing. Repayment of the loan, on the other hand, represents a decrease in financial liabilities, and therefore repayment of the loan should have a negative sign because cash is going out. So, this is one way to determine whether a particular item should have a positive sign or a negative sign. We have to think about that item in terms of the sources of funds or uses of funds. So, if the item represents a source of funds, then it should have a positive sign. And if it's the use of funds, then it should have a negative sign.